If you've ever looked into monthly paying ETFs, you've probably come across covered calls. At a basic level, it's a strategy where you sell call options on the investments you already own, collecting the premium as income. It's been around forever with professional traders, but in the last few years, it's become much more mainstream. You no longer need to run this strategy yourself or touch any derivatives. Fund managers now package these into covered call ETFs that do all the work for you. And that's how you end up with products that look incredibly appealing on the surface, double-digit yields on broad market indices compared to just 1 or 2% you'd get from standard ETFs. So you can immediately see the attraction. It feels like free income on top of what your portfolio is already doing. But before you rush out and buy anything that pays 8 to 12% yield, you really need to understand what you're giving up to get that yield, because there are meaningful trade-offs. A basic covered call strategy is where you own the underlying stock, and then in order to produce extra income, you would sell call options on that stock. A call option gives the buyer the right to buy a stock at a specific price, and they pay a premium for that. So by selling a call option, you receive the premiums from the buyer of that option. In this example, we're selling out of the money call options, and that just means that the option is not in profit right now. Just focus on the orange dotted line for now. That's what would happen if you just own the stock outright. So on the y-axis, you've got the profit and loss, and on the x-axis, you've got the stock price. Let's assume that where that dotted line crosses the horizontal axis is where the stock price is right now. So now to produce extra income, we're going to sell a call option that gives the buyer the right to buy the stock at the price marked X. This is out of the money because it's above where the stock price is right now. From selling this call option, we receive a premium, which is why our break-even point shifts left on the graph. And now if this stock was to increase in value anywhere up to its strike price, this would act in exactly the same way that if we just held the underlying stock, plus the premium that we've received from selling the call option. However, if the stock was to increase in value past the strike price, then the buyer of that call option is now going to exercise the right to buy that stock because that call option is now in the money, which means as a seller of the call option, our upside is now capped because we have to sell the underlying stock to the buyer of that call option. And this is a key trait of a covered call strategy where you have a capped upside, but you have a virtually uncapped downside. The only benefit is that downside is slightly reduced because you still receive the premium. So the main benefits of this strategy is that you have 3 sources of income. You own the underlying stock, so you can still receive dividends on the stock that you own. You can also get some price appreciation up to its strike price. So the stock can still increase in value because you own the underlying. And as long as it doesn't go past its strike price for that call option, you can benefit from the appreciation in value of that stock. And then of course the premiums as well. And you receive the premium regardless of what happens to the price of the stock. The other benefit is you have a slightly reduced downside risk. If you just own the stock outright, you would participate in all of the downside if that stock was to fall in value. With a covered call strategy, you would still participate in most of the downside, but because you're also receiving the premiums as income at the same time, it reduces that downside risk ever so slightly. So the best scenarios for a covered call strategy is where a stock is gradually increasing in value, but not so much that it's hitting its strike price. So you're still participating in the price appreciation, but you're not having to sell the underlying because it doesn't hit the strike price. At the same time as still receiving the premiums from selling the call options. They can also be beneficial in a market that's going sideways or that's a little bit choppy, because if you just held the underlying, your returns are essentially going to be flat. Where with this strategy, because you're receiving the premiums, you're still getting a return in a market that's just trending sideways. But the main drawback to this kind of strategy is that capped upside. So if a stock goes on a rally, you can't participate in all of that upside. At the same time, if that stock was to crash or simply fall in value, you still participate in most of the downside. The premium slightly cushions it, but you're still going to get most of that downside risk. And it's these traits that mean the biggest risk to a covered call strategy in the long run is in its recovery from downturns. Because you're still participating in most of the downside risk, it then can't recover as quick as just holding the underlying stock because you have that capped upside. These are 3 fairly new ETFs from JP Morgan that all employ a covered call strategy, with a focus on a specific index for its underlying holding. And this year in particular has given us a really good example to compare these funds with their benchmarks. So if we look at the JP Morgan US Equity Premium Income Active ETF, and compare that against its benchmark, the S&P 500. The covered call fund is in orange and the standard S&P 500 fund is in blue. We can see quite a large downturn in about March this year, and most markets experienced this because this was when Trump announced his tariffs on most of the world. And during this downturn, you can see the orange line being slightly above the blue line all the way down to its bottom. And that's because the fund is receiving the premiums despite the underlying stock coming down. But it's in the recovery where most covered call strategies are at risk. And you can see how much the blue line has moved away from the orange line. And in just over a year, a typical S&P 500 ETF has performed 15.9% compared to the covered call ETF, which has performed 3.8%. This is also including dividends being reinvested. So if you were taking income from the covered call ETF, your portfolio would actually be down. We can see the same things with the NASDAQ, where during the downturn, the covered call is benefiting from the premiums over holding a typical ETF. But again, in the recovery, you can see how much the blue line moves away from the orange line. And in just over a year, the typical NASDAQ ETF has performed 22.09% compared to 15.82% in the covered call strategy. And the last example is quite an interesting one because this is looking at the JP Morgan Global Equity Premium Income Active ETF, which has the objective of investing into companies from developed markets, but the key is that it gives a higher weighting to companies it feels that are undervalued. And it's because of this, during 2024, when it was mainly tech stocks that were rallying, a typical ETF was outperforming this strategy. However, when it then came to the downturn in March 2025, it was the companies that were sitting at higher valuations that saw more of a drop, which meant this type of covered call fund managed to survive that downturn with a relatively flat graph. But of course, when the recovery did come, you can see how much the blue line is now moved away from that orange line because the covered call fund can't participate in all of that upside. In just under 2 years, a typical MSCI World ETF has performed 40.81% compared to the global covered call ETF performing 14.85%. These types of funds will pay out monthly, which is a big appeal to a lot of investors, but the main trade-off is that total return. For some, they may be happy with that trade-off. They prefer taking the income from the fund rather than having to sell down investments, and especially if they feel like the market is going to move sideways rather than going on another rally for the next couple of years, then this type of fund could be beneficial. But it's important you're aware of the risks and the trade-offs by going down this kind of approach. If it is natural income that you're specifically looking for, then it could be worthwhile comparing to your typical dividend ETFs. For example, looking at ETFs such as developed markets, UK or Euro-based dividend ETFs. The dividend yields will likely be lower and they do pay out quarterly, but if the outperformance from these types of funds continue, then the payments could be higher later down the line. So really it comes down to your risk tolerance, where you see markets in the next few years, and how active do you want to be in the market. If you really want to simplify your investing, I have a free ETF cheat sheet that you can download. It breaks down the most popular ETFs in different regions and different sectors, makes it easy to compare. It's the top link in the description below. If you want to see how quickly your investments can compound by focusing on total return, then watch this video next. Thanks for watching. I'll catch you in the next one.